The third account doesn't blow up the way the first two did. There's no panic, no anger, no denial. Just a quiet recognition that something fundamental is wrong. Most traders never reach this moment. They stop at the first failure or the second. They change indicators. They change brokers. They change mentors. They stay the same person. The third loss is different because by then you already know how to trade, at least technically. You can read charts. You understand risk. You've had green days. You've had weeks where it worked. And still, the account is gone. That's the point where strategy stops being the explanation. I know a trader who went through this exact arc. Smart, disciplined on paper, consistent enough to believe the problem was temporary. Each blowup was framed as bad execution, bad conditions, a lapse in focus. The story always sounded reasonable, until it happened again. The third time, there was no excuse left that didn't collapse under its own weight. The losses weren't reckless. The entries weren't random. The system wasn't obviously broken. But the result was always the same. That's when the real question finally appeared. Not how to trade better, but who this style of trading was actually built for. Most people think changing time frames is a technical decision. Lower noise, higher probability, fewer trades, more patience. That's the surface explanation. In reality, a time frame shift is an identity shift, and that's why it fails for so many people. This trader decided to move to weekly charts after the third blowup, not as an experiment, as a last option. Intraday had taken everything it could take from him: attention, emotional energy, sleep, confidence. Weekly charts felt boring, slow, almost insulting to his skill set. That reaction mattered more than he realized, because boredom is not a market condition, it's a psychological signal. Intraday trading rewards immediacy, feedback, constant engagement. You are always doing something, always reacting, always involved. Weekly charts remove you from the action. They don't ask for speed. They don't care about your screen time. They don't reward cleverness. They reward restraint. For someone whose identity was built around being sharp, fast, and decisive, this felt like a downgrade. And that's where the conflict began. The charts didn't change first. He did. But not in the way he expected. At first, he tried to trade weekly charts like they were slower intraday charts. Same urgency, same need to be right, same discomfort with waiting. It failed, quietly. Not with dramatic losses, with small, persistent mistakes, early entries, over-analysis, position sizing that didn't match the time frame. The account didn't blow up. It bled. That was more dangerous, because letting lets you believe you're adapting when you're actually resisting. Here's the part most trading education never touches. A trader's preferred time frame is a mirror of how they experience control. Short time frames give you the illusion of control through activity. You feel involved, you feel responsive, you feel skilled. Longer time frames strip that away. They force you to accept that most of the time, the best action is no action. For someone conditioned by years of lower time frame trading, this feels like incompetence. He wasn't uncomfortable because weekly charts were difficult. He was uncomfortable because they exposed how much of his confidence came from constant decision-making, not from long-term consistency. This is where many traders quit the shift and return to what feels familiar, not because it works better, but because it feels like them. The trader remembered something he had read years earlier about Nicholas Darvis, not the box theory, not the stocks, the lifestyle.
Darvis didn't sit glued to screens. He structured his life around distance from noise. He built systems that worked without his presence. That detail had seemed irrelevant before. Now it felt like the point. Weekly charts weren't just a strategy change, they were a demand. A demand to stop identifying as someone who needed to be involved all the time. That realization hurt more than any loss, because it reframed the first two blowups. They weren't failures of discipline, they were successes of identity. He had been perfectly consistent at being the wrong type of trader for his own psychology. The third blowup didn't teach him a new lesson. It removed his last excuse. At this stage, many traders tried to rebuild by adding rules, fewer trades, harder stops, stricter filters. He did something different. He reduced exposure not just to trades, but to markets themselves. He stopped checking charts daily. He limited how often he allowed himself to think about positions. This felt irresponsible at first, but something unexpected happened. The anxiety dropped, not because the trades were winning, but because his sense of self was no longer tied to constant monitoring. Weekly charts gave him time, and time exposed how much of his previous stress came from self-imposed urgency. Urgency that had nothing to do with opportunity. This is where the disruption becomes inevitable. If you cannot trade a higher time frame without feeling restless, impatient, or disconnected, the problem is not the time frame. It's the identity that needs stimulation to feel competent. The market doesn't reward stimulation. It rewards alignment. And alignment doesn't feel exciting. It feels empty at first. That emptiness is where most traders turn back, because emptiness feels like losing an edge when it's actually losing a crutch. The trader didn't become profitable immediately after the shift. That's important. What changed was not the equity curve. What changed was the internal pressure. For the first time, his performance wasn't measured daily, or weekly, or even monthly. It was measured by how well he could stay out of his own way. That standard was unfamiliar and uncomfortable, but it was honest. The third blowup didn't force him to learn a new strategy. It forced him to grieve the trader he thought he was. And until that grief was processed, no time frame would ever work. Not intraday, not daily, not weekly. Because time frames don't fail traders. Identities do. After the shift, the trader noticed something unsettling. His best ideas felt weaker. Not worse in quality, worse in certainty. On intraday charts, conviction came fast. A setup appeared. The decision followed. Action created relief. Win or lose, the loop closed quickly. Weekly charts broke that loop. Ideas formed slowly, sometimes over days, sometimes over weeks. And in that time, doubt crept in. Not analytical doubt, existential doubt. When you wait long enough, every idea starts to look fragile. This wasn't a flaw in the charts, it was a flaw in how he had learned to trust himself. Intraday trading trains you to trust speed. Weekly trading demands trust in restraint. These are not adjacent skills, they are opposites. At first, he tried to force conviction by consuming more information, macro reports, earnings transcripts, sector flows. That made things worse. More information didn't increase clarity, it increased noise. He realized something uncomfortable. He had been using information as a substitute for patience, activity as a substitute for confidence. The conflict wasn't between strategies, it was between two versions of self-worth. One version felt valuable when making decisions, the other felt valuable when letting decisions mature without interference. Only one of those could survive on higher time frames. This is where many traders misinterpret the struggle. They think they are under-trading. In reality, they are under-identifying. Their sense of usefulness is tied to frequency. When trades become rare, the mind looks for other ways to feel relevant, tweaking, adjusting, interfering. That interference feels like risk management. It isn't. It's anxiety looking for justification. The trader began journaling again, but not trades. He journaled impulses, the urge to check charts outside his plan, the discomfort of not knowing, the subtle resentment toward positions that didn't move. What emerged wasn't a pattern of bad decisions, it was a pattern of impatience disguised as diligence. Weekly charts didn't need his intelligence as much as they needed his absence. That sentence took time to accept, because absence felt like negligence. He had built his identity around being alert, being early, being prepared. Weekly charts didn't reward preparation in the same way. They rewarded acceptance of uncertainty. You place a trade, you define risk, and then you wait. No adjustment, no management theater, just waiting. This is where the deeper realization arrived. He hadn't been losing money because his entries were wrong. He had been losing money because he couldn't tolerate being wrong slowly. Intraday losses are sharp. They end quickly. You move on. Higher time frame losses unfold over time. They test patience. They test narrative. They test ego. You have to live with the possibility of being wrong longer. That's not a technical skill. It's a psychological one. The third blowup made sense now. Each account died not because of a single mistake, but because of repeated interference driven by discomfort with uncertainty. Short time frames had masked this by allowing constant resets. Weekly charts removed the mask. At this point, he remembered another detail about Darvis that had gone unnoticed before. Darvis didn't just trade less, he thought less about his trades once they were placed. He trusted structure over intuition, rules over feelings. That wasn't discipline, it was self-knowledge. Darvis knew the part of himself that would interfere, so he built distance. The trader had done the opposite for years. He had placed himself as close to the market as possible and called it engagement. That engagement had a cost. Weekly charts made the cost visible. There was a period where nothing seemed to happen. Trades sat open, equity moved sideways, the mind grew restless. This was the danger zone, not because of drawdown, because of boredom. Boredom is not neutral, it provokes action. In trading, boredom is one of the most expensive emotions. It whispers that something must be done, that inactivity equals stagnation, that stillness equals incompetence. The trader almost went back, not because intraday worked better, because it made him feel like himself again. That urge was the realization. If a strategy only works when it reinforces your identity, it is not robust. Robust strategies survive indifference. They don't need emotional buy-in. This reframed everything. Weekly charts weren't meant to feel engaging. They were meant to feel distant. That distance was the feature. Once he stopped trying to feel productive, the process stabilized. He sized positions smaller than his confidence suggested. He accepted that many weeks would pass with nothing to do. Something subtle shifted. He stopped measuring progress by outcomes and started measuring it by interference avoided. Days without checking charts became wins. Weeks without adjustments became success. This would have sounded absurd to his earlier self, but it worked. Not in the dramatic way social media promises, in the quiet way that prevents damage. The realization was simple, but not easy. He didn't need a better system, he needed a system that protected him from his strengths. Speed, intuition, decisiveness. Those traits had made him feel skilled. They had also made him vulnerable. Weekly charts required different virtues: patience without boredom, conviction without urgency, distance without detachment. These are learned slowly, and only after loss. The third blowup wasn't a punishment, it was a filter. It filtered out the trader he wanted to be and left the trader he could actually sustain. This wasn't improvement, it was alignment. And alignment doesn't announce itself loudly. It settles in.
Once the realization settled, the work became quieter. There was no dramatic turnaround, no sudden confidence, no sense of having figured it out. Instead, there was subtraction. He removed tools before adding any. Indicators first, then opinions, then exposure to commentary. What remained was price, time, and a small set of rules that were intentionally boring. The first application was structural. He limited decisions to a fixed window, weekly review, orders placed, risk defined, then disengagement. Not discipline enforced by willpower, discipline enforced by design. He stopped tracking performance daily, not because it was unhealthy, but because it was irrelevant. Weekly charts do not respond to daily concern. That mismatch had been a source of constant friction before. The second application was psychological. He reframed waiting as work. Waiting was no longer empty time, it was execution of the strategy. Doing nothing became a measurable action. This mattered more than any rule, because it changed how he experienced inactivity. He wasn't behind, he was aligned. The third application was identity-based. He stopped calling himself a trader in the way he used to. Not out loud, internally. He no longer saw his value in how quickly he reacted or how often he acted. His value came from staying within a process even when there was nothing to do. That shift reduced pressure in ways he didn't expect. Losses hurt less, wins felt quieter. Both passed without demanding interpretation. This is not the version of trading that gets attention. It doesn't produce stories. It produces durability. Over time, the equity curve stabilized, not explosively, gradually. The account survived. That was the first milestone. Survival doesn't feel like success until you've failed enough times to respect it. He noticed something else. His life expanded. When markets were no longer consuming his attention, other things filled the space. Sleep improved, focus improved, even decision-making outside trading improved. This wasn't balance as a lifestyle choice, it was balance as a consequence of structural restraint. Weekly charts didn't just change how he traded, they changed how much trading took from him. There were still moments of temptation, a fast move, a news event, a setup on a lower time frame that looked perfect. The difference now was not resistance, it was indifference. Indifference is not apathy, it's clarity. He could see those setups without needing them. That's when he understood what the third blowup had actually taken. It took away the need to prove something to the market. Without that need, the market stopped feeling personal. That's the resolution most traders never reach. Not mastery, detachment. Not emotional detachment, structural detachment. You define the terms, you participate on those terms, and you accept whatever follows without interpretation. This is where weekly charts finally made sense. They weren't slower versions of intraday trading. They were a different relationship with uncertainty. A relationship where you stop negotiating with each fluctuation, where you accept that most outcomes are unknowable in the short term, where you judge yourself by adherence, not results. This doesn't make trading easy, it makes it sustainable. Looking back, the trader could see why the first two blowups were necessary. They hadn't been severe enough to challenge his identity. They hurt financially, but they left his self-image intact. The third one didn't.
It forced a reckoning. Who are you trading as, and who does your strategy require you to be? Those two questions rarely match on the first attempt. Time frame shifts expose the mismatch faster than anything else. If you feel compelled to act, the time frame is too short for your psychology. If you feel bored but stable, you may be finally in the right place. Weekly charts don't suit everyone. That's not the point. The point is that no strategy works in isolation from identity. You can learn setups in weeks. You can't rebuild self-concept without friction. The trader didn't become someone new. He became someone narrower, less reactive, less involved, less urgent. And that narrowing created room. Room for consistency, room for survival, room for compounding that didn't depend on intensity. The third blowup wasn't the end of his trading career. It was the end of the version of himself that couldn't stop interfering. That version had felt skilled. It had also been fragile. Weekly charts didn't make him better. They made him honest. And honesty in markets lasts longer than confidence.